Welcome to the deep dive. When you think about financial success, usually the first things that come to mind are, well, math, spreadsheets, maybe algorithms.
Yeah, complicated equations, all that stuff. We tend to think money management is this, cold, hard, logical science.
But the research we've looked up for today, a lot of it inspired by Morgan Housel's work,
Uh,
kind of turns that whole idea on its head.
it really does. The core insight, the big one, is that financial success has surprisingly little to do with how smart you are. It's almost entirely about behavior.
Okay, let's dig into that. Because the decisions that really matter, the ones that determine if we end up, rich or truly wealthy,
Huh.
they aren't made by some Excel spreadsheet.
No, not at all. The sources say they're made around dinner tables with ego, pride, fear, and personal history. That's where the real action is.
Right. So our mission today is to move past the cold numbers and look at the strange, sometimes messy human side of money. We're focusing on those mindset shifts that can lead to real, lasting wealth.
Okay, so picture this. You see someone make what looks like a totally bizarre decision with their money. Maybe buying some super risky stock, or maybe refusing to invest in anything but cash.
Yeah, your first thought might be, wow, that person is just irrational.
Exactly. But this research, it challenges that judgment. It introduces this brilliant idea, financial DNA.
Mm-hmm.
Basically, everyone has a unique financial fingerprint.
A fingerprint stamped on them by the economy they grew up in, right?
Precisely. And this leads to a really powerful conclusion. People do some crazy things with money, but no one is crazy.
I like that phrase, no one is crazy. It forces you to think differently.
It does. It means you have to understand that every financial decision makes perfect sense. Well, at least to the person making it. It's based on their own unique, limited, but high-impact experiences.
Okay, let's make this concrete. Talk about generational experiences, like the stock market. If you were born around, say, 1970.
Right. So if you were born in 1970 in your teens and 20s, your formative years, you probably saw the S&P 500, that's the big U.S. stock market index, go up almost tenfold.
Tenfold, that's huge. So that experience would likely create a kind of deep-seated optimism about stocks.
Absolutely. A positive view, a higher tendency to invest whenever you can. Now, contrast that with someone born just 20 years earlier, maybe 1950.
Okay, what did they see?
Well, during their teens and early 20s, the stock market basically went nowhere. It was flat.
Ah, so that teaches a very different lesson. More skepticism.
Much more skepticism, a more negative view, less desire to jump into stocks. They learned the market might just be a place where your money sits there, or worse.
And you see the same thing with inflation, don't you?
Exactly the same pattern. Think about people born in the 1960s. They lived through some really significant, painful inflation during their youth.
Yeah, I remember my parents talking about that.
So for them, there's this permanent high awareness of inflation, a really negative view of how it can just eat away at your savings.
But then if you were born later, say 1990.
Well, you've experienced relatively low inflation for most, if not all, of your adult life so far.
So it's less of a concern, less top of mind.
Much less concern, yeah. Lower awareness of what sustained inflation can actually do to your buying power over the long haul.
So the big takeaway here for you, the listener, is pretty crucial then. If your own financial behavior or someone else's seems strange, it's probably not because anyone's illogical.
Right. It's because we're all justifying our choices based on this mental model built from our own limited personal history.
And the challenge is recognizing that our past experiences aren't necessarily the whole story, and they might not predict the future.
Exactly. So if our history shapes our behavior so much, how do we overcome those biases? How do we improve our odds of success?
Well, the material suggests the answer isn't about predicting the market perfectly. It's about leveraging the one thing every single investor actually controls.
And that is time.
Okay, Warren Buffett, often called the greatest investor ever, his skill is, undeniable.
Absolutely. But the research points to something maybe even more important than skill for his success. Something incredibly simple, but really hard to copy.
Which is?
Time. Just sheer longevity. Staying in the game.
The stats on this are pretty wild, aren't they?
They're staggering. Okay, get this. Of Buffett's, let's call it $84.5 billion net worth, something like $81.5 billion, that's over 95% of it, was earned after he reached his mid-60s.
After 65, wow.
Yeah. I mean, he was a good investor, no doubt. But he was a good investor since he was literally 10 years old. That gave compounding almost 80 years to work its magic.
80 years. That really underscores the power of starting early. The sources even ran a hypothetical on this, right?
They did. They asked, what if Buffett had started later? Say, like many people do, waited until age 30 to get serious about investing.
Okay, and even if he still got his amazing 22% average annual return,
His net worth today wouldn't be $84.5 billion. It would be closer to $11.9 million.
still a lot of money.
Like,
But yeah, 99.9% less than his actual fortune.
exactly. It wasn't necessarily the genius returns he made in his 20s that made him super rich. It was the fact he was investing it all back then. It gave his later returns a huge base to grow from.
Okay, but let me push back a little here. Is this just survivorship bias? You mentioned Jim Simons in the research, the hedge fund guy.
Ah, Simons, yeah, Renaissance Technologies.
His average annual return since 1988 is something like 66%, right? That absolutely blows Buffett's 22% out of the water.
It does, 3 times higher.
So shouldn't he be the wealthiest person on the planet then, if the return rate is that much better?
That's the perfect question. And it actually illustrates the power of compounding even better. Simons is incredibly wealthy, don't get me wrong, around $21 billion.
But that's still, what, 75% less than Buffett?
Right. And the key difference is time. Simons didn't really hit his investing stride until he was 50, so he had less than half the time for that amazing return to compound compared to Buffett.
Okay, I see the time gap. But still, 66% a year, that's just astronomical. What if Simons had started as early as Buffett? What would the math look like?
This is where it gets kind of mind-bending. The sources estimate that if Simons had applied his 66% annual return over Buffett's 70-plus year time frame.
His net worth wouldn't be billions, or even trillions.
What then?
It would be around 63.9 quintillion.
Quintillion. Okay,
Yeah.
that number, it's more than just funny math. It really changes how you should think about investing success, doesn't it?
Fundamentally, it shows success isn't just about being the smartest person in the room or getting the absolute highest short-term returns. It's about how long you can stay in the game, how many innings you get to play.
So having a good, solid, reasonable return that you can stick with for a really, really long time.
That beats a spectacular return you can only hold for a short while, every single time. Because of that exponential growth, staying power is the ultimate advantage.
All right, so if time is the big accelerator, the research also talks about luck and risk. Describes them almost like siblings, right? These external forces. Yeah, like the wind and the waves affecting a sailboat. You, the captain, have skill, you have a plan, but you can't fully control those outside factors. They definitely shape the journey.
And there's a really stark example of this in the early story of Bill Gates.
Oh yeah, the Lakeside School story. It's incredible luck, really. So back in 1968, there were maybe 300 million high school-age kids globally.
And Gates happened to go to Lakeside, which was pretty much the only high school in the world at that time that had a leased computer terminal.
A 1 in a million shot of luck. It gave him this unbelievable head start, thousands of hours of programming experience nobody else had.
But then there's the flip side, risk. The research talks about Ken Evans.
Ken Evans, yeah. He was right there with Gates and Paul Allen.
Yeah.
Just as smart, just as into computers.
But he experienced the other side of that 1 in a million probability.
He did. He died in a mountaineering accident before graduation. A tragic, basically 1 in a million risk event.
It's a really powerful point. Talent and hard work are crucial, obviously, but they aren't the whole picture. They're always subject to these outside forces of luck and risk.
And that leads directly into another key idea for investing success. Understanding tail events.
Okay, break that down. What exactly is a tail event?
Think of it like this. Imagine baseball. Most games, maybe you win by a run or two, maybe you lose by a run or two. Pretty normal outcomes.
Right.
But a tiny number of games, way out in the tail of the probability curve, are these massive blowouts, huge wins. And those few huge wins might account for, say, 80% of your team's total run difference for the entire season.
Okay. So in investing, it means a small handful of things drive most of the results.
Exactly. A few outliers account for the vast majority of the outcomes, the crucial part. You don't have to be right most of the time.
You just need those few big winners to really pay off.
Precisely. Look at the art dealer Heinz Berggruen mentioned in the sources.
Yeah.
He collected tons and tons of art. Turns out 99% of the pieces he bought were, not that valuable in the end. But the 1%, the Picassos, the Klees, that small fraction led to a $100 million sale. Those few winners paid for all the duds many, many times over.
And you see this with big companies, too, like Amazon.
Perfect example. Amazon's incredible growth wasn't from hundreds of small successes. It was largely driven by just two massive tail events, Amazon Prime and Amazon Web Services, AWS.
And those two basically covered the cost of huge failures like the Fire Phone.
They did, and Jeff Bezos totally got this. After the Fire Phone bombed, he famously said something like, "We're working on much bigger failures than that right now,"
Wow. So he saw failure as necessary.
as the cost of admission, the necessary price you pay to find those rare, game-changing 1% winners.
So for us, as regular investors, the lesson seems pretty clear then.
Yeah. Diversify, be patient. Even Buffett, the master stock picker, apparently made most of his fortune from only about 10 of the nearly 500 stocks he picked over his career.
Only 10.
So it's okay to be wrong often, as long as you're diversified enough to catch a few of those big tail event winners and you stick around long enough for them to really grow.
Okay, before we go further, we need to make this distinction the research emphasizes. Between being rich and being wealthy, they aren't the same thing.
Not at all. Richness is basically what you see. High income, flashy car, big house, maybe expensive jewelry. It's often funded by current earnings, or sometimes debt. It's visible.
But true wealth, that's different.
True wealth is what you don't see. It's the financial assets you haven't spent yet. The savings, the investments. It requires discipline, self-control, restraint. Wealth is built by consciously not spending the money you have.
This connects to that man in the car paradox, right?
Yeah, it's a great little thought experiment. People buy expensive status symbols, a fancy watch, a luxury car, because they want admiration, respect from others.
They want people to see them in the Porsche and think, wow, that person must be really successful and cool.
Right. But ask yourself, when you see a Ferrari drive past, what are you usually looking at?
The Ferrari. I'm probably thinking, man, I wish I could drive that car.
Exactly. You're looking at the car and maybe imagining yourself in it. You're probably not spending much time admiring the driver inside.
Wow. Yeah, probably not.
Nobody cares about the person in the car nearly as much as the person driving the car does.
Yeah.
You're spending your money trying to impress people who aren't actually thinking about you.
That's it.
Well, that's a pretty bad return on investment, emotionally speaking.
So if buying fancy stuff doesn't really bring lasting happiness or admiration, what does wealth actually get you? What's the real payoff? The highest dividend?
The sources are incredibly clear on this. The single highest dividend money pays is the ability to control your own time.
Control your time.
To wake up each morning and say, I can do whatever I want today. That freedom, that autonomy.
And studies back this up, right? Control over your life is a better predictor of happiness than salary.
Far better. More dependable predictor of positive feelings of well-being than your salary level, the size of your house, or the prestige of your job. But here's the paradox.
What's that?
If you chase richness, the visible stuff, by working harder and harder, longer hours, taking on more stress to afford the next bigger thing, you often end up trading away control over your time.
Right. You become a slave to the lifestyle you're trying to maintain. You defeat the whole purpose.
Exactly. You end up with less control, less freedom, even if you have more stuff.
Okay, and related to this, there's the idea of the price of investing, not just the dollar cost.
Yes, the non-monetary cost. Think about climbing a mountain. Going in that risk, uncertainty, maybe some fear, physical struggle. That's the required price you pay for the amazing view from the summit.
Makes sense. You don't expect to get the reward without the effort and risk.
The stock market is exactly the same. The volatility, the dips, the uncertainty, the fear you feel during downturns, that's not a fine or a penalty for doing something wrong. That's the price of admission for capturing long-term returns.
So trying to avoid that volatility, like selling everything right before you think there's going to be a dip or jumping in right before a boom.
That's like trying to get the summit view without climbing the mountain. Or, as the source puts it, trying to steal the car from the market, getting the returns without paying the required price.
And the price for, say, the 11% average annual return the Dow Jones gave from 1950 to 2019 wasn't just money.
No, the price was enduring decades of uncertainty, fear, ups and downs, recessions, crashes, and sticking with it. If you see that emotional toll, that volatility, as something to be avoided at all costs.
You'll inevitably try to time the market, jump in and out.
And you'll likely miss out on the real power of compounding entirely. You have to be willing to pay the price.
Okay, another big behavioral trap the research highlights is figuring out when enough is actually enough. This idea of the hedonic treadmill.
Ah, yes, hedonic adaptation.
Yeah.
Is that tendency we all have. You hit a financial goal, you get the raise, you buy the bigger house, and for a little while, you feel great. Then you adapt. It becomes the new normal.
Yeah.
And you start looking toward the next goalpost, thinking that will be the thing that finally brings lasting happiness. The goalpost keeps moving.
It's a treadmill because you're always running but staying in the same place happiness-wise.
Exactly. And the sources point to extreme examples, like Bernie Madoff or Rajat Gupta. These were already incredibly wealthy individuals.
Multi-millionaires.
Right. Yet they resorted to massive fraud and insider trading. Why? The suggestion is because for them, all the money in the world would never have been enough. That feeling of more, of perpetual wanting, is incredibly dangerous.
And a big part of that treadmill is comparing ourselves to others, isn't it?
That's maybe the biggest driver. Comparing your wealth, your house, your car, your life to others. It's a game you literally cannot win. There will always be someone with more. It guarantees the treadmill never stops.
So this leads to a really interesting conclusion about decision-making. We don't necessarily need to make purely optimal financial decisions.
Right. We need to make reasonable ones. You don't have to be a perfect, cold, calculating financial robot like a Microsoft Excel spreadsheet.
What's an example of reasonable versus optimal?
Well, think about paying off your mortgage early. Let's say you have a mortgage with a really low interest rate, like 3%. Mathematically, optimally, you should probably keep that debt and invest any extra money, aiming for a higher return in the market, say 7% or 8%.
Right, the math says invest the difference.
But maybe having that mortgage hanging over your head stresses you out. Maybe the idea of being completely debt-free, owning your home outright, gives you incredible peace of mind.
Okay.
Paying off that low-interest mortgage early might not be the mathematically optimal decision for maximizing your net worth on paper in 30 years, but if it helps you sleep soundly at night.
Ah, the sleep test. Does this investment let you sleep at night?
That's the core of being reasonable. If eliminating that debt, even if it's cheap debt, provides a huge emotional dividend, maybe reduces anxiety, that peace of mind is a return. It might be worth more to you than chasing that extra few percent in potential market gains.
So it's about finding what works for your own psychology, your own risk tolerance, not just what looks best in a financial model.
Exactly. Focus on strategies that are reasonable for you, that you can stick with, that let you sleep at night, rather than constantly chasing the absolute highest theoretical return, which might cause you to panic and make mistakes anyway. Hashtag outro.
Okay, let's try to boil this down. What are the main mindset shifts we've covered today that separate maybe just being rich from being truly wealthy?
I say there are three big ones. First, recognizing that your behavior, your psychology, your personal history with money, that matters way more than how good you are at math or finance theory.
Okay, behavior over brains. What's number two?
Time in the market is vastly more important than trying to time the market. Longevity and consistency beat chasing spectacular short-term returns. Let compounding do the heavy lifting over decades.
Got it. Time is the secret sauce. And number three?
The highest dividend that wealth actually pays isn't the stuff you can buy. It's freedom. It's independence. It's gaining control of your most valuable asset, your time.
Behavior, time, and control. Excellent summary. All right, let's leave our listeners with a final thought to chew on.
Okay, so the world is just inherently surprising, right? Think about the 2008 financial crisis. Who saw that coming in quite that way? Or the global pandemic in 2020 shutting everything down almost overnight.
Yeah, black swan events, things you just can't predict.
Exactly. The sources even mention things like World War II tanks being disabled because field mice chewed through critical wiring. The biggest risks are very often the ones that are completely unforeseen.
So if you can't predict these things,
Yeah.
what do you do?
Well, your job isn't to become a fortune teller. That's impossible. Instead, the real goal should be to build your finances in a way that they are, it's essentially unbreakable.
Unbreakable, how?
By having enough margin of safety, enough flexibility, enough cash reserves maybe, enough of a buffer so that when, not if, but when the inevitable unpredictable shocks hit, you can survive them. You can stay in the game.
So the most important part of your financial plan
Is planning for the moments when your plan inevitably goes wrong because the world throws you a curveball you never could have imagined. Build in that resilience.
build that margin of safety. That's a great place to end. That's our deep dive for today. Until next time.